Senores Pharmaceuticals is officially in hyper-growth mode. The Q3 FY26 review is out, and the numbers are explosive, with revenue up 64% and net profits soaring by over 100%. Let's break down the investment insights behind these massive gains. The Q3 scorecard is impressive. Revenue hit 178.34 crore rupees, growing nearly 65% year-over-year thanks to heavy demand in the US and Canada. Net profit outpaced revenue growth, doubling to 33.58 crore. We're also seeing major margin expansion, with EBITDA margins hitting 30.28% and EPS climbing to 7.29 rupees. Why is profit growing so much faster than revenue? It's a classic case of operating leverage. By shifting toward high-margin niche products and lowering finance costs, Senores expanded its PAT margin to 18.83%. Essentially, the company is keeping significantly more of every rupee it earns. The engine behind this growth is the regulated markets segment, primarily the US and Canada. This sector brought in 112.7 crore in revenue, up 61%. Most importantly, it's operating at 40% EBITDA margins, which is significantly higher than the industry average for generic drugs, proving their specialty and niche strategy is working. We're also seeing a massive turnaround in emerging markets. Just a year ago, this segment was barely breaking even with a 1% margin. Today, margins have jumped 1,200 basis points to roughly 13%, turning this into a serious profit contributor with record quarterly revenue of 38.4 crore. Don't overlook the sleeper hit, branded generics. This segment is scaling aggressively with over 600% growth as they supply large Indian hospital chains. While the exact revenue is undisclosed, it adds a powerful third layer of growth alongside their international business. A major strategic catalyst is the 75% stake in Apnar Pharma. The integration is moving faster than expected, which does two things. It enhances their US manufacturing footprint and opens up high-value CDMO, or contract development opportunities. Future visibility looks strong. The pipeline currently has 46 approved ANDAs and another 22 in development. On the growth side, they are investing 107 crore in an Atlanta facility for sterile injections. Only a small fraction has been spent so far, meaning there's a long runway for future expansion. Financially, this is a fortress balance sheet with a net worth of 858 crore. They used IPO funds to completely repay their debt and still have nearly 138 crore in cash parked in fixed deposits. This dry powder gives them the capital to fund new acquisitions whenever they want. Is the money real? The quality of earnings check says yes. While cash flow from operations is lower than net profit, it's still positive. The gap is simply due to the working capital needed to support that massive 64% revenue scale-up. The verdict? Profits are being realized. Of course, every investment has risks. The risk radar focuses on regulatory exposure. USFDA compliance is absolutely critical for their facilities. There's also execution risk regarding the new 107 crore injection facility, which needs to come online smoothly to generate a return on that capital. The final verdict is constructive. The bull case is supported by high margins and hyper growth, while the bear case hinges on regulatory hurdles. If execution remains this consistent, the growth story is very real. Follow for more smart investing insights.